Greetings, and thank you for listening to KBRA's update on recent trade dynamics. My name is Joan Feldbaum-Vidra, and I look after KBRA's sovereign ratings. I also follow global geopolitical developments closely. In this update, I will share KBRA's thoughts on what heightening trade conflict means for the global outlook in the context of a very altered policy environment. This environment is characterized by loosening monetary policy across many of the world's markets, especially the U.S. KBRA just authored a piece on a related topic called Renminbi Devaluation, Trade Wars, and Global Liquidity. The title is quite self-explanatory, but the main takeaway from that research piece is that debtors are exposed to falling debt service costs, while debt sustainability risks could rise over the longer term. So what's the latest? Basically, the recent escalation ramps up the threat of tariffs on just about all the imports out of China. On August 1st, the Trump administration announced new tariffs on almost $300 billion worth of products, starting September 1st. However, two things are important to note here. Number one, most of these items are consumer items, so that's important. But the second thing is the sequencing has been changed. In a more recent announcement, more than half of those products are now being subject to tariffs on December 15th. So what does that mean? That means that falls after Black Friday, that falls after Cyber Monday, so that gives ample opportunity for lots of consumer spending. So we'll watch out for that. Going into the holiday season, it could very well be that growth and consumer spending remains strong, to the extent that holiday shopping is not procrastinated. And what does this mean for the U.S. economy? Well, remember, the U.S. economy is quite a closed economy, not overly dependent on exports to imports. And how much at maximum does the U.S. import from China? Let's say $500 billion. Well, that's a huge amount, but not very huge when you look at it compared to the size of the U.S. economy, which is over $20 trillion in size. Consumer demand is the key variable that has been fueling U.S. activity. Moreover, many onlookers would say that we're quite firmly entrenched in an interest rate cut cycle, and borrowing costs have already come down precipitously for floating rate debt holders. Just look at the 10-year treasuries. It's adjusted from over 3% at the end of last year to about 1.6% today. That's just 8 months. Of course, the disruption due to the trade conflict is palpable, no question. It's definitely impacted investment, and it's definitely shaved a few percentage points off of U.S. GDP. But the IMF, just last month in July, revised its growth forecast for the U.S. It actually expects growth to be more strong this year at about 2.6% for the year. That's a healthy rate. That compares to potential growth of 2.5% in Mexico, which is an emerging market, and generally emerging markets grow much faster. That also compares to a full 1 percentage point slower growth in the Eurozone, which is growing much slower despite negative interest rates in that area. For the U.S., many economists think that tax cuts have actually been more powerful in contributing to the growth story than have the tariff talks. Primarily, this is due to the money that's being put in consumers' pockets. However, let's say that miraculously an agreement between the U.S. and China is signed. To repeat, as I noted, we don't think that the trade conflict will be overly punishing to the U.S., but the polar opposite could actually be quite significant, coincidentally. But all of this depends on investment and confidence. To the extent that an agreement, if that were to be signed, would stimulate greater investment, that could have a profound impact. It also could reduce uncertainty over China, and there's been quite a bit of global concern over China's slowing growth in the context of its very hefty leverage. As KBRA continues to expand our global coverage, we pay very close attention to all of these developments, as what goes on in the bigger economies can also move the needle for other ones as well. The bottom line, we monitor these developments closely, but we monitor them always in the context of all geopolitical developments. Finally, the challenge for KBRA is to always keep our eye on debt sustainability, meaning the ability to generate growth without undue dependency on leverage accumulation. Thanks again for joining us.